Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. So the budget is done and dusted, and from the looks of it, the markets have given it a big thumbs up. Now as investors, all of us watch the budget with keen interest. We try to look for hints on which sectors and stocks are likely to benefit the most from the budget announcement and which ones are likely to get hurt. To be honest though, I find this whole exercise pretty hard to wrap my head around. You see, there have been many budgets over the last couple of decades or so. In fact, there's one every year. Now, some of these budgets have been good from a stock market point of view, while others not that great. But the fact remains that stock markets have continued to make new highs every few years, and they will continue to do so in the future as well. So, do the budgets really matter from a long-term point of view? I don't think so. As long as the budgets don't stifle the so-called animal spirits in the economy to any meaningful degree, I don't think budgets matter that much from a long-term perspective. A little bit of tinkering here and there is not going to disturb India's long-term growth story. Then why is it that investors watch budgets with such keen interest? Well, this is because they believe that budgets can change the entire fortune of a sector and the stocks within that sector. And by getting into those stocks as early as possible, they can ride the entire upside in their share prices. But is this possible? Can this idea work in real life? Well, I have my doubts. First, I don't think that budgets can suddenly turn a decent quality business into a good quality one or a bad business into a decent one. And even if it does, it is not a good idea to buy such businesses. A business should be good or decent based on its internal qualities. It should have systems and processes in place that make it a good or a decent business. If a business needs a favorable budget to turn its fortune around, then buying such a business is not an investment in my view, but is more of a speculation. And you should not speculate a lot with your hard-earned money. Secondly, even if the budget is likely to bring windfall gains for a particular sector, it is hard to quantify such gains and therefore assign a proper valuation to the underlying stock or the sector. And who is to say that those gains are not already reflected in the company's share price? I think these are all important things to consider, and yet there are no clear answers. Therefore, buying a stock just because the sector it belongs to received some special sops in the budget is not my idea of a well thought out investment. One cannot be sure of success here. Instead, I'm going to recommend another strategy that's much simple and has a very strong chance of earning you market-beating returns if you implement it on budget day every year. You see, back in 1976, the year that he passed away, Benjamin Graham gave a series of interviews around value investing. He was asked about an investment policy an individual investor should follow over the long term. What followed were 3 simple rules that are the most important things you will learn all of this year. Here they are. Rule number 1, be an investor and not a speculator. What is the difference, you may ask? An investor is someone who finds out the intrinsic value of a stock and always buys a stock below this intrinsic value so that there is a sufficient margin of safety. Now, how do we calculate a stock's intrinsic value? Well, you don't really have to. All you should figure out is whether the price is significantly below its intrinsic value or significantly higher. For example, say a stock has traded at an average price to book value of 1.2 times over the last 5 years. It's quite clear that the stock is undervalued at 0.8 times book value and overvalued at 1.8 times book value. Let me repeat that. If the average price to book value is 1.2 times, then at 0.8 times the stock becomes undervalued, and at 1.8 times it becomes overvalued. So you should definitely buy the stock if it goes below 0.8 times or below and sell it after it reaches 1.8 times or higher. If it's trading around 1 times or 1.5 times book value, then you should choose to ignore it. When it comes to valuing a simple business, this much knowledge should be enough in my view. The problem arises when you are trying to value a loss-making business or a high-growth business that's trading at expensive valuations. In this video, we will stick to the simple method that I just discussed. So that was rule number 1. Invest and do not speculate. Buy a 100 rupee note for rupees 75 or lower. Rule number 2 is have a definite selling policy. We will keep this simple as well and have a minimum holding period of 3 years. We will hold all the stocks in the portfolio for 3 years and then create another brand new portfolio for the next 3 years. You can also have a 2-year holding period, but do ensure that it is no less than 2 years and not more than 3 years in my view. We will discuss the third rule later. Let us focus on the first 2 rules for the time being. Now let's go back to 10th July 2014, the first budget of the newly elected Modi government. Arun Jaitley, in fact the late Arun Jaitley, the then finance minister, has finished his speech and all your friends are busy trying to figure out the winning and the losing stocks based on the budget. You, however, are focusing on the Ben Graham formula and have put together a portfolio based on the following rules. Price to book value of 0.8 times or lower as of 10th July 2014. We are considering a stock's intrinsic value to be 1 times its book value and are therefore buying it at 20% or lower. There's one more thing. We want the intrinsic value of the company to be growing or at least staying stable. Therefore, we don't want any loss-making or high-debt companies because these two are the most common ways of destroying intrinsic value. So another condition is that the last 3-year debt-to-equity ratio of the company should be all less than 1 times. In fact, less than 0.5 times, and also the company should not have made losses in any of the last 5 fiscals. That's it. These are the buying rules, and of course the selling rule is that we hold the entire portfolio of 10 stocks for 3 years. Now I have used a portfolio size of 10, but you can use 15, 20 or even 30. However, it is advisable to not go beyond 30. Here are the 10 stocks that these rules would have helped me identify and their returns over the next 3 years. Well, those are impressive returns whichever way you look at it. A portfolio constructed using our simple rules would have led you into a huge 9-bagger like Force Motors and a 5-bagger like PPAP Automotive. There are some other impressive performances as well. In fact, here's how the equal weighted 10 stock portfolio would have done vis-a-vis the benchmark index, that is the Sensex. It would have outperformed the Sensex by almost 8 times. Now that's a whopping outperformance in my view. Before you consider this as a one-off case, let us consider another union budget. So cut to 2 years later, the budget of 2016, once again presented by the late Arun Jaitley. Once again, the same portfolio rules apply. Here are the 10 stocks that these rules would have helped me identify in Feb 2016 and their returns over the next 3 years. Well, this is not as impressive as the 2014 post-budget portfolio, but still not bad in my view. There is a 4-bagger here and a couple of 3-baggers. Here's how it would have done vis-a-vis the Sensex. Again, not as impressive as the first portfolio, but still a market-beating performance. So there you are. I don't think there is any such thing as a post-budget portfolio. The idea is hard to implement and profit from. A much better approach in my view is create a portfolio based on the strategies outlined by Ben Graham and use that instead. Now, in case you're wondering what kind of stocks will these rules throw up today in the aftermath of the 2022 union budget, well, let's not delay it any further. Here's a list of 20 stocks that have shown themselves up based on our rules. Now, you can perhaps do some research of your own and create a 15 to 20 stock post-budget portfolio. Mind you, these are not stock recommendations by any stretch of imagination, and you are advised to do your own research or consult your investment advisor. Now, if you remember, there was also a third rule by Benjamin Graham about moving our allocation between stocks and bonds. I think one of the reasons Portfolio 1 and Portfolio 2 ended up doing so well was because those portfolios were created when the markets were attractively valued. Back in July 2014 and Feb 2016, the broader market wasn't as expensive as it is right now. But right now, markets are expensive, and hence it may be a good idea to take only 50% exposure to these stocks. Then once the market corrects by say 20% or more, you can increase your allocation and take it up to 75% maximum. Mind you, if we would have taken 75% exposure to stocks and invested the remaining 25% in fixed deposits in our first and second portfolios, that is the budget 2014 and post-budget 2016 portfolios, even then you would have ended up with a market-beating performance. I think having a minimum exposure of at least 25% to fixed deposits at all times does help, as it prevents the portfolio from going down too much during a market crash. So you can certainly listen to Graham and have a minimum 25% exposure to fixed deposits at all times. By the way, if you like my approach to investing and you think it makes a lot of sense from a long-term perspective, then you should try out my brand new learning course, The Lazy Millionaire. In Lazy Millionaire, I help investors put together a sound framework of investing, and the one that requires zero knowledge of accounting, economics, or sectors. It's based on a proven approach to investing. So please do check the description box and click on the link therein for more details. I will see you again next time. Thank you so much.